Hi everybody! In today's video we're going to look at my main early retirement fund and the bashing my Vanguard account is currently taking. Let's start. In case you're new here, I'm Marta. I'm a Polish turned British designer living in London, and this channel is my personal finance and good life playground. If you're into either of those, feel free to subscribe. Welcome. As usual, we're going to look at my portfolio and answer some of your questions. But first, comment of the month. This channel celebrates doing, not just talking. I love all your comments, but the one that stood out in March is by Kate. Here it is. Some kind words, more kind words. As soon as I finished watching this video, I've created a similar Excel spreadsheet to budget my finances for the next month. I'm a recent graduate and starting my 25k job in March, so I'm super excited and committed to learn more from you, and so on, so forth. Kate, this is for you. Best of luck to you with budgeting. I personally think it all starts with this powerful habit. And this is for you, our All the Honeys t-shirt with the symbol of abundance, of which I hope your life will be full, and the All the Honeys branding on the back. I hope you like it. I will contact you for your details so I can have one made and shipped to you. Once again, fantastic results. Now then, it's time to look at the questions I'm going to answer today, during and after the Vanguard Portfolio update. Here they are. I keep the original writing, so please forgive typos and so on. The first one came to me via Instagram. Here we go. I wanted to invest in an accumulating ETF for drip purposes, to let them reinvest the dividends. However, I cannot find the dividend yield of the products on Vanguard. Can you help me? Question number 2. You showed in this video some graphs of your ISA pension performance. It's all new to me. Any chances you could explain in more details what those graphs are actually showing? Is it what you paid into, or is it just the profit generated based on what you paid into the fund? And finally, the third question. Everyone always talks about using the stock market to compound your money over many, many years. Now, I get compound interest, but the way I understand how you make money, non-dividend way, is that you buy a share of something and then sell it later at a higher price to make profit. This is a linear increase, not a compound one, but I don't get why people always talk about it like this. I also get dividends, but they pay very low amounts, about 2% for some of the index funds I was seeing. This is what they say. The SP 500 on a very long average returns approximately 10% per year. And then they try to say that if in year 1 you deposit say £1,000, the next year you make 1,100. And then the year after you make 1,210 compound. But surely in reality it is only the difference in share price that matters, as you have to actually sell your share to make that profit. But if you sell your share, you would then have to reinvest into the same stock at the new share price, so you make no profit. I'm sorry for the length of the question, but I just don't get why people keep mentioning compound interest. Thank you for all these questions, they're all great. I will answer the first two during the update, and the third one after the update, because it's a bit more elaborate and can be treated separately. Now let's grab access to space and time continuum, aka my laptop, and answer the first question. Now, no matter what information you're looking for, and no matter what fund you're looking for, if you're like me, you do know that Google as a browser beats any type of search functionality on any page. So to avoid getting frustrated, we're just going to skip that step and omit Vanguard and just go straight to Google. Okay, let's look at Vanguard High Dividend Yield World ETF. The first one should be good enough. Here we go, we have all the information here. Anything we could ever dream of. And then when we go into the distributions tab, we have our yield here. And all the ex-dividend dates and stuff like that. Of course, we looked for a quite random fund, but if you have the name of the fund, the process is pretty much the same. You just Google it and then you look for the distributions tab. Alright then, let's open Vanguard and take a look at my portfolio. I'm 2 days late with this update. I usually aim for the 8th of each month, the day of my first investment with Vanguard. But never mind, at least we can enjoy some windy and rainy weather instead of glorious sunshine 2 days ago. The current value of my portfolio is 103 and then £30.89. In my previous update, I was considering paying some more money into my SIP, and I gave in to that temptation because to me Vanguard is like a shopping center. I love shopping here, and so I contributed £10,000 to my SIP. Let's take a look at my pension. Let's take a look at the transactions. So you can see on the 16th of February, I contributed £10,000. Let's take a look at the investments. No change here. I added the 10k to Target Retirement Fund. Now, if you wonder why I added this money to this fund, the answer is simple. I did it for ease. I'm more than happy to pay a bit extra in fees for this fund and have peace of mind. This will be my main fund in my SIP. It could change in the future, but for now I'm okay with that. Let's look at the performance. You can see it's going up. Calculations. Month by month. Basically, we're interested in the last month. So from 56,600 to 57,500. So slightly more. My rate of return is 25%. Now let's take a look at my ISA. These are my ISA holdings. One is in red at the moment. Performance since 8th of October 2019. And I think now it's a good time to answer the second question. Here's a reminder. So these dots represent points in time, and they show balance of your portfolio on those dates. Now if we use this slider here, we can actually zoom in here. These dots appear every week. So you can see that on the 5th of January, my ISA was worth the whole balance. So not only profits and not only the capital, everything together was worth this much. And a week later, this much. And again, another week. You can tell it's every week. That's the balance of the portfolio every week. And then you can have a bigger picture when you move that slider to the left. Calculations, month by, and we're interested in this number, so it's slightly up since the previous update. Now let's take a look at investments. And if you remember from our previous update, there was a bug here concerning capital return and gross return. And one of the viewers, Chirayu, thanks Chirayu, pointed out that it was actually fixed. So I checked the moment Chirayu let me know. You can see that these numbers are not the same again. So, for example, my FTSE All World ETF capital return, so the return on my capital only without all the other things on top of that green tennis ball, if you remember. If I were to withdraw it today, my return would be 21.25%, but together with everything on top of that tennis ball, so my gross return would be 23.55%. So the bug has been fixed. So finally, let's take a look at my whole portfolio. All of my holdings are here. Performance. So again, the same graph, but for the whole portfolio, so balance every week. of the portfolio since I started. Calculations, month by month, investments, and the best tab of them all, insight. So here we are, product types, geographical regions. This is the most fun to see. Top 10 investments, sector allocation, and performance in the last 3 months. Going back to performance, my current rate of return for the whole portfolio is 27%. Now, as most of you probably know, the markets are actually having a bit of a red-only party at the moment, and I put that £10,000 right before it started, which is classic. And if you wonder how it makes me feel, all I can say is the beauty of investing in a SIP is that you can't really touch this money for decades. So worrying about it, worrying about something like a slight drop in the market while having this long-term perspective is a bit futile. Markets go down, markets go up, let it be. Investing is a long-term activity. There is not much room for instant gratification here. So if you bite your nails when you're checking your portfolio, don't check your portfolio. And if you're pining for instant gratification, there's something else you can do. Instant satisfaction. So this is what my early retirement fund looks like this month. If you're here just to see the numbers, then thank you for watching, and I hope to see you next month. But if you want to find out the answer to the last question, let's take a closer look at it now. Agreed, this is a normal of a question. So let's tackle it in stages. But first of all, let's actually try and understand what the real problem here is. I think here it is in a nutshell. How on earth does compounding really work? I know you said you understand compounding, but whatever you said after that makes me believe that there's a bit of confusion here. You mentioned calculations, but I don't think you're quite convinced by them. Then you state that you don't really get why it's always being referred to when people talk about long-term investing. So let's try and clear it now. We'll use the figures, the numbers you used, so that we don't get too many numbers, too many examples, and one big headache. And first, let's choose one type of investment, because you mentioned shares, you mentioned index funds, you mentioned SP500. This is not a buffet. Let's just focus on one main meal, and we'll choose an index fund for ease. It will be our investment. We'll not choose SP500 because SP500 is not accumulative, so it doesn't reinvest its dividends. We'll choose a non-existing index fund called AF fund. The name of the fund is completely irrelevant here, but just for the sake of it and to celebrate our creativity when it comes to fund naming, we'll call it AF fund. So accumulating fund. As you know probably from my previous update, this is what a typical investment looks like. We're starting with our capital, right? So the money we put in, as you say, you buy something. We buy this index fund for £1,000. Yes, this is our fund. Now in biology we have a structure of neuron, in physics we have structure of atom. Well, in finance world we'll have a structure of an investment. We're starting with this, and now we let it grow. So what happens with time? The value of this fund changes. The price, as you would say. So it's not going to be £1,000, it would be, let's assume, higher. So let's kind of agree that this is the linear money making you referred to in your question. Everything makes sense so far? I think it does. Now, with time, we also get other things on top of our capital, right? We get interest, we get dividends, and we get capital gains distributions. Remember? So this is the structure of our investment now. Just because you use that number, let's assume that all of it, all this gross return, not capital return, is 10% per year. Yes? Easy. Now let's use some money to actually understand how it works. So we have our stocks and shares ISA, our vehicle for driving us to financial independence. We opened one and we put our £1,000 in. Clear. Now a year passed and this £1,000 generated us 10% on top of our capital. So when we check the account in December, ta-da, we have 1,100. I think up to this point we're on the same page. We know that compounding exists, we know it works, and we know it works over many, many years. The question to ask here is what happens next and what changed and why. So we're in December and then comes January. What did we invest? We did not invest £1,000 anymore. We invested 1,100. Our starting point changes. So in December the following year, with the starting point of 1,100, what we get is, as you mentioned, 1,210, because our starting point was different. And then come the following January, again, our starting point is different. It's as if we put more money in, just because that interest is adding up. It's compounding. So it's changing our starting point every January. Compounding basically works because you don't touch that initial capital. Of course, if you make some deposits, if you put more money in, it's going to compound quicker. But if you don't, if you just leave it and let it be, assuming the promise of 10% interest per year and just giving it time, it will make you quite a lot of money long term. Now let's check if these numbers are correct and how far this £1,000, given time, given our not touching it, and the promise of 10% interest per year can take us. So let's use the tool that all the people who strive for financial independence just love, a compound interest calculator. Here we are, I already put the numbers in. Our initial deposit is £1,000. Our interest rate is 10% per year. Let's give it 10 years. These parts, compound interval, we just keep it as yearly, and we are not depositing any money and we're ignoring inflation for now. Here we go. Our future investment value, so in 10 years time, our £1,000 will be worth £2,593.74, just because we never touched it. And look at these numbers. Correct. First year it will be this much, but then we're starting with this much. So next year it will be more, and then more. We haven't changed anything. We made no deposits whatsoever. But just because the interest compounds, just because we're changing our starting point every year, it's growing. Now let's get back to the final part of your question. But surely in reality it is only the difference in share price that matters, as you have to actually sell your share to make that profit. But if you sell your share, you then have to reinvest into the same stock at the new share price, so you make no profit. Again, we're forgetting it's a share. Yes, it's price change, so yes, it's value changed, but also we got some goodies on top of it, and that compounded. So we put in £1,000, but in 10 years time we don't have £1,000 in there anymore. We have at least £2,500. So the question here is, when do you want to have that profit? Because it's long-term investing, I assume it's not next year on it, or it's not the year after. If you're going to withdraw some of your funds in 10 years time, the value of them is so much higher because of compounding, because of hopefully you investing more and more, that you don't need to sell all of your funds. You only sell a part of them. Now, as a rule, you can withdraw 4% of your total savings per year, adjusted for inflation, for at least 30 years without exhausting those savings. So when people talk about long-term investing and retiring early, like me, we usually look at that 4% rule and then we flip it in order to calculate our number we need to have to be able to withdraw that 4% every year. That will be enough for us to live on. In other words, you're never in a position when you need to sell 100% of your investments. You only sell a tiny bit of them. And the 4% rule that is tried and tested says if you only sell off 4% of your total savings per year, these savings will last you for 30 years. Alright guys, so this is what my early retirement fund looks like this month. Next month will be in April. I don't know how it happened, but April is already here and we will be starting a new financial year. So I will be able to put some money into my ISA. We'll see how it goes. Thank you very much for watching. I hope you enjoyed this video. I hope you learned something and I'll see you soon. Bye.